Mo, here we are back. Another show, the last show for the month of May.
I know.
And man, wrapping up the season and school year and all these kids finished and complete. And of course, the standard routine of everyone's morning with kids is now like out the window.
It's gone.
It's
gone.
gone.
Yeah. I mean, let's see. My kids are waking up now at 10 o'clock easily. Before it was, good 6:30, 6:45. Now it's 10:30. But it's good. They worked hard throughout the school year, especially Liv. She was homeschooled for the last semester. Grayson, between soccer and, he's a junior now, and SATs and all that good stuff. So he had a lot on his plate this year.
Yeah, it's a lot.
So they're enjoying this season of life. And so
I got a random question about that.
Which one?
So my question is, what's your thoughts about requiring them to wake up at a specific time throughout the summer, even if they don't have to?
I agree with that. I like that idea. Just so they can get, yes, summer is a break from school, but it shouldn't be like a complete transition from getting things done, right? Getting motivated, starting your day off on a right track. So, does it have to be 7 o'clock in the morning? No, but I think, 9 o'clock in the summer is a good time to get up, get going, so that by like 10:30, your day started.
I feel like 9 o'clock is generous, Well, the reason I ask is because when growing up, mom and dad, of course, dad was off to work. Mom was pretty adamant that there was no sleeping in. Like, sleeping in probably for us, I think was around, matter of fact, I think we had to be up by 8. And then immediately, you're ready and you got to get your bedroom made.
Okay.
Not really for any reason. We weren't going anywhere. We were at that time, probably too broke to go anywhere. But looking back as an adult, I contribute a lot of my discipline, even on the weekends, to get up and get the day going to that, discipline that my parents had. And, so I'm kind of the same way, to the point that I actually ordered well, there's 2 reasons I did this. I ordered clocks.
Okay.
Literally the, just old school alarm clocks for each of my kids.
Really?
I did it. Yeah. Off Amazon. This like literally 2 weeks ago. along with a charging, it's like a device that has the ability to slide multiple phones in.
I know what you're talking about. Yeah.
Yeah,
Okay.
like a hub or whatever. Because some of what we're actually going to get into as far as the summer show that we're going to put together and the podcast and all the things we're going to cover, I've been motivated to kind of, basically get more discipline in how we are handling our kids' access to their devices at various points throughout the day. So I thought, well, if I'm going to take their phones and ensure that they don't go to sleep with them and they can't keep them in their bedroom, then I need to have a place where they can put them.
Right.
And so here's their charging, all that good stuff. So I got that. Well, when I did that, I thought, well, they don't have an alarm anymore. Not that they used it anyway.
Gotcha.
Okay.
But just in case if they needed one, they needed an actual alarm clock or something to keep
I'm
wake them
thinking
up.
they need it. I'm thinking, why are we waking the kids up every morning? Like, my oldest is almost 16 years old. You could get your butt out of bed.
Yeah, I've stopped. I don't wake the kids up anymore.
Yeah, so I'm a little, we're softening it up. It's time to, flip the switch on. So anyway, that's why I asked.
Yeah, no, I agree with you. I agree. And part of that hub that you were talking about, I know it goes back to the book that we're going to read over the summer for our next series, The Anxious Generation, which, from all what I've heard, and so have you, from our pastor at the Crosspoint Church and others who have read the book, that it's a must read for to understand this new generation now with respects to all the social pressures and anxiety and social media presence and influence that it's having on kids nowadays, especially teenagers. When you look at, suicide rates, mental issues, mental health issues, just all the things that they're going through and how it all ties back to the rise of social media and the smartphone and direct access to, just all the news and information that they have access to that's really playing a really major part in their identity and all the anxiety issues that they're going through.
And I feel like what you said was perfect. We need to understand. And the truth is, we really, at least for me, I'll speak for me. I don't know if I've done a well enough job to really comprehend exactly what all they're facing because, as you and I both are fairly young men,
Yeah.
at least I hope. I mean, you have no hair and mine's pretty gray.
Yeah, that's true.
But needless to say, I don't feel like totally disconnected from that generation. My son, who's about to be, my oldest 16, Benji's 13, and Jake's 10, and it's not like we grew up in a dramatically different world. But then I sit here and thinking about like, no, actually we are.
Yeah.
What they're facing doesn't, from a time frame standpoint, doesn't seem that long ago. But from a technology perspective, it's like light years.
Oh my gosh, yes.
We have a beeper, and what was it?
Pager.
You get the best thing we could do is get on the computer and get on AOL chat.
Oh yeah, I remember that.
I'd be killing
Messenger.
AOL Messenger. Man, doing your thing. And anytime you had the opportunity to log into somebody else's, you could create a nightmare.
Oh, that was awesome.
Yeah, it was great.
Good old days of like, I guess there's got to be statute of limitations at this point, but like downloading music, on Napster or all those different sites.
Napster.
It'll take an hour to download a song, but that was awesome, right? I mean, it was different. It was a different time. Now, just the idea of, being able to go on Apple Music, download an entire album and just play it right then and there, that type of access.
Kids have no clue, man.
But, just communicating, right? I mean, like my ability to communicate with my friends were at school.
Mm-hmm.
And then when school was done, maybe kids are in the neighborhood, but that's it. Right. But now it's like 24/7. You have access at any given moment between Snapchat, Facebook, Instagram, all the different social media devices and platforms that are out there. It's just constant communication.
And I guess when I'm thinking about that, us as adults, we've kind of morphed into a lot of what our kids are challenged with because, like, I think about us communicating. You're right. When we were kids, there was no texting.
Yeah.
So if you wanted to get on the phone, I can remember, getting on the landline there at the house and, laying there and just literally talking to your buddies or, just talking and talking and talking. Nowadays, even as adults, we don't even like to get on the phone either.
No.
We're texting. And so our kids see us not communicating, not being social in a lot. And then we look at them like, what's wrong with you guys, your generation? Why ain't you getting going? And it's like, we don't even understand what all they're faced with. So, to your point, this summer's going to be a ton of fun. We've been working toward getting to a lot of different topics in regards to what our youth is educated with, how to think through their high school, even their high school career path, just so many different things that we want to go over. And then all of a sudden, our church brings up this series on Think and then the book that they've referenced. So we thought, why not?
Why not?
We'll just jump in, do the book, and then also hit some of the episodes, or not episodes, but some of the content and subject matter that you and I wanted to cover. So with that said, to anybody that listens to the show, get the book.
Yeah.
Do it with us.
Yeah, do it with us. Yeah, you're going to enjoy it. We did a book series last year, completely different topics about the laws of wealth. But this one, it was fun. We had clients join us. They were asking us questions. They were involved, engaged. And so, listen to the show. Stay connected. Buy the book. Again, it's called The Anxious Generation.
Anxious Generation.
And follow along with us. It's going to be, an 8 to maybe 8-10 weeks, depending on how long we stretch it out. But it's going to be a good series for the entire summer to stay connected with.
Perfect. Yeah. So we got to wrap up a series that you and I have been working on real estate investing.
Yes.
Okay. Now, granted, right out of the gate, real estate, as we've discussed, pretty solid investment.
It really is. It's a great asset to add to your overall investing journey and strategy and portfolio. And there's so many different ways that you can invest in real estate, right? You can invest in a REIT. These are exchange funds, or you could buy a REIT exchange traded fund, right? And that's invested in the market. You become partner in real estate. But what we've been talking about really is actually owning physical property, right? Whether it's residential, commercial, but actually owning those properties and what can do for you to build and amass wealth over time.
And it does some pretty incredible stuff. I mean, we've talked about not just the benefits of things like cash flow. These are heavy, strong cash flow producing investments, but they also appreciate just the property value in and of itself. We know that. I mean, since the housing market crash of 2008 up into the current state, I mean, even in the past 5-7 years, dramatic increase in property value really across the country, right? Different areas, maybe different levels, but across the board, seeing nice increases in property value along with the cash flow. And, we talked about how to analyze property, how to get into investments, because the truth is, Mo, and we see this with some of our clients, but, a lot of people want to get their feet wet, if you will, in real estate, just because it seems like the right thing to do. Now, with that said, we also have a lot of clients, if not maybe a good portion of them, who have attempted real estate and they look back and think, psh, not for me.
Yeah.
Never going to do it again. And it really boils down to, from our perspective, on whether or not you view real estate as a business or not. Because when you look at real estate as a business, you kind of have a different expectation. Natural entrepreneurs, when they jump into a venture, well, they expect headwind. They expect a challenge. They expect, may have to work a little late tonight,
Yeah, the approach is completely different, right? I mean, for those who aren't really thinking about it, if you look at the time and effort it takes to build, well, first of all, just to buy a property, right? But then to maintain it over time, and then to duplicate it and replicate it, it takes time and it's a process. And when you really take a step back, you're actually running a business.
Yeah.
And if you don't approach it as if you're running a business, you're gonna come in. Those headwinds that you mentioned before are going to be more dramatic than if you if you run it as a business. Those expectations are just part of the course.
That's exactly right. And so it's easier to navigate.
Right. Exactly.
I mean, you and I know that real well with building the investment firm that we have here, Asset Management Group. The truth is no business. I would say for most, it doesn't come easy, right?
Yeah.
You got to work, you got to grind, and as a part of that, you get and hopefully get to reap the rewards. But real estate's no different. So, if you missed, if any of the listeners to our podcast or YouTube channel has missed some of those shows, I think it's great content. Jump back in there, watch the videos, listen to the podcast, great stuff. But as a wrap up, there are two topics that we have yet to cover. One of them is flipping property.
That's right.
And how to finance options on flipping property, how to really navigate those short-term deals. Well, we have an interview coming up in a few weeks. We're going to tackle that subject with a couple that literally does it for a living. So that's going to be a ton of fun. But the topic we want to hit today is a big one.
It is okay.
A big one. And Mo, it's a topic that really resides, I'm going to say, with the majority of high net worth clients we work with. And that is, how do we use real estate as a tax deduction to reduce just the general tax liability that me and my family face every year? This is the hurdle. How do we fix it? And real estate offers a lot of tax benefits. It just does. But like we've talked about with real estate and any other investment, the deal is made the benefits are made in the deal.
Yeah.
Right. So whether you're looking at, creating good quality cash flow, creating good quality, just overall return, okay, a lot of that is created when you purchase the property. Well, taxes is really no different. You kind of need to have an idea of what you're trying to do from a taxable standpoint before you purchase a property, so that you purchase the right property to support the tax strategy you want to deploy. Does that make sense?
Yeah, it makes total sense, because some of the strategies that you can use to really benefit you on a tax basis is really dependent on the type of property you're purchasing. You mentioned we didn't talk about flipping at all this series, really, but some of the strategies that we're going to talk about today don't really apply to flipping homes.
Right.
So if your idea was, well, I want to get into real estate, for tax purposes, I want to reduce my taxable income, so I'm going to start flipping houses. And you make your first 2 flips, and then you at the end of the year, you go to your CPA and say, "Look what I've done," and they say, "Well, congratulations. None of these tax strategies are going to work for you."
Right.
And so you all of a sudden deployed cash into a venture that really wasn't the right opportunity for you. Real estate was the right opportunity, or could have been the right opportunity, but the actual properties, or the way you purchased those properties and what you did, wasn't the right one for you.
You're exactly right. And, it doesn't make the real estate, like you said, a bad deal.
Right.
You could have made money.
You could have made money, yeah.
But your goal is not, and maybe for some people, the goal is not just to make money. It's also to make money while reducing
your taxes.
Another problem that they have on the books. And so let's tackle it. All right,
Okay.
Let's jump in. So when we're thinking about the benefits of real estate from a taxable perspective, I would say that there's kind of this general overarching idea that, number one, real estate, being that it does create a ton of great tax strategies, still should not be the only focus as to why you buy real estate. Okay, you shouldn't jump into real estate just for the sole purpose of tax deductions. Although it's attractive and you may want to, you still need to know it's a business, because there are other things that it entails. What I think most people do, okay, and I'm speaking for the majority of the clients that we serve that own real estate, few of them run it like a business. They look at their real estate portfolio like a business. Most, they have 1 or 2 properties. Those properties do exactly what they want them to do. So let's start there.
Yeah.
The average person, they lose a loved one, inherit a property, or maybe they're not married yet, so they own a house. They then find a spouse, they get married, they end up with a rental property. In that situation where someone just has a few rentals and they do view their rentals as number one priority is cash flow,
Okay.
where do they get the tax benefits from?
I'd say the number one for that type of situation is, your standard write-offs, right? So these are deductions that you're able to take just for really maintaining, for having the property itself. So it's, property taxes, insurance, just the cost of repairs, or, just your traditional upkeeping of the property itself. You're able to write off those expenses. And so that's your standard, kind of a templated way of using real estate to reduce your taxes. It's taking those standard write-offs.
Yeah, just, normal operating
For
expenses.
Right, exactly.
Well, and I would say too, maybe just like standard depreciation.
Yes.
Obviously the house over time is going to depreciate as a result of, and when we say depreciate, maybe we should define that. We're not talking about the house itself, the value of the home going down. We're talking about the IRS rules regarding depreciation. And you have the right to deduct the depreciated value year over year.
Right. So everything from, the structure of the house, right? Everything that goes into the house itself, the IRS basically says you have 27 and a half years basically to depreciate the value of the house over time. And so, that's, if you think about it, right, every part of the house, it will have some wear and tear at some point. And so the IRS says, okay, well, because of that, we're going to give you we're going to allow you to use and offset that depreciation from your income.
Yeah. If my boys live in your house, you have more depreciation.
Yes.
Yeah. Things go out way quicker.
Yeah. Drew and Olivia broke one of our tables the other day.
Oh, you throw that on me.
Yeah. Yeah. That pool table depreciated really quick. I'm just kidding.
I know. Listen, we got back from we went on that golfing trip. We got back from that golfing trip. I'm not kidding. I literally just purchased this brand new steel weed eater.
Oh, gosh, what happened?
And it's like a heavier duty weed eater to cut some of the rental properties and stuff. So my boys, I have them cutting like 3 different yards in downtown. And so if any of you guys see young kids on lawnmowers headed down the main road in downtown Adairsville, you'll know it's ours. But we have those gates at the front of our fence, those iron gates in the historic home that we live in. Benji has the steel weed eater kind of off the back of the four-wheeler. Okay, so it's sticking off the back of the four-wheeler.
Yeah.
He's not paying attention and just wide open is leaving the house. Weed eater catches one of the iron gates, and I mean, like literally folds the metal arm.
Oh, the weed eater? Mm-hmm. Oh, no.
Of course, he doesn't tell me. And I go check to see how they're doing on the property, and Ben's like trying to get the line fixed or whatever. And I go and I'm like, what happened? Like, what do you even say? I'm like, just whatever.
Yeah.
Anyway, depreciation. No, that's just another expense.
That's just another expense.
Yeah. Which, by the way, just so everybody knows, there's a difference between an asset and expense.
That's right.
Right? So when you have an expense, an operational cost, which is what you're talking about, these are just expenses that are a result of operating a property. The next phase we see are individuals that may own a few properties, but now they're like, okay, we need to kind of build an entity around this. All right, they're not getting too crazy with it, but they do form an LLC to own the 2 or 3 or 4 properties. And what they're doing is now they're saying, okay, when I go buy the weed eater, I want to deduct it. Mm-hmm. Okay, so now this is not an expense to the property. This is an expense to the company.
That's right.
Or it's an asset of the company that will depreciate. Okay, now mine has to be an expense because otherwise it would have depreciated rather quickly, much quicker than what it should have. So in this situation, Mo, nothing too complex, but they're running it kind of like a little bit of a soft business here, right? Trying to catch some of those expenses in the entity.
Yeah, now it becomes a qualified business expense, right? And so if you think about it, most of our clients who are in this situation right now, they are operating their business from their home, right? Mm-hmm. They have a laptop, they have a dedicated space in their house where there's a printer, computer screens, they're actually running their business there. And so now all of a sudden you can, just that example right there, you can look at that room as an office space and start using that as a way to deduct for a business expense. You're traveling back and forth to visit the properties. Here comes another qualified business expense, right? Maybe you're advertising for renters. You're advertising for, if you're doing short-term rentals, you're advertising for guests. All of this, all of a sudden becomes not technically a write-off. I guess it is, but it's more of like a business expense now because this is what it takes. These are the expenses that it takes just to maintain the business itself.
Yeah, you're kind of using the entity to really filter out some of the revenue from the real estate. Obviously, a lot of our clients, they're buying real estate because it generates a lot of cash flows. So you got to reduce the cash flow, at least on paper, so that you're reducing your taxable income. And you form the LLC, and you, like you said, you got the business that you have to operate. So you're at the house with your computer. Well, the computer, guess what? It's an asset.
That's right.
That will depreciate. Yeah, on the computer, what do you got to have? You got to have Microsoft 365 Business, right? So as a result, your subscription is an expense to the business. Your internet that you have to be able to ensure that your utilities get paid and all that stuff. So
any subscriptions, anything that any conferences you're going to, any subscriptions to, different sites that you're using at different payment platforms. All these things are become business expenses.
They do. They become business expenses, and at least in that situation, reduces the taxable income as a result of the income generated by the properties. Right? Okay. With all that said, is it valuable? Of course. It's a benefit, and there's a lot of reasons to own real estate, and taxes being one of them. But there are individuals out there, Mo, that are high-income earners, okay? And not high-income earners per se with just real estate, just general high-income earners with maybe another business that they own or their W-2 income. You and I both know this. We have several clients that either own companies or they're high W-2 income earners with, serving as an executive or some type of, high position with an organization, such as income estimates would be like, as an example, household income at, 250, 500 for modified AGI, 750, $1 million plus. And so we have clients that are bringing in significant amount of income. Well, guess what the problem is? They got a darn
Yeah, right.
load
Big tax bill.
of taxes.
Right.
Yes. And well, that's their biggest concern. Okay. It is. They're spending anywhere from, 75,000 to 400,000 in annualized federal tax payments, along with state. So what are the questions these clients ask every single meeting?
How can I reduce my taxes?
How can I reduce it?
Yeah.
And the problem is there's no way to reduce the tax liability as a result of the W-2 income with the employer, because the employer wants it off their books. That's why they're the employer, right? They want to be able to send the money to you, and as a benefit of sending the money to you, they get to deduct 100% of that cash flow as an expense, their payment. Now, what that client can do is invest in real estate. Now, their purpose for investing in real estate should still be to form a real estate portfolio.
All right.
But the benefit, if they do it correctly, could be massive, massive tax savings.
Yeah, you were telling me about it's not a client of ours, but a friend of someone you know that had a bad experience when he first started doing real estate. Because his intention was for tax benefits, but it ended up not being.
Yeah. Not doing
anything for him tax wise.
Anything. And the reason that is, and this is just it's a tragedy, but I think it happens more often because, listen, people are listening to our podcast show YouTube channel. You get online and you go and just type in real estate investing.
Oh my gosh.
Some of these channels and some of these shows, man, got hundreds of thousands of views plus, and it really sounds attractive, right?
It sounds easy.
It sounds easy. It sounds attractive. It sounds simple. And so, yes, people get into jumping into real estate, investing for the purpose of reducing the tax liability against their federal income from other sources like W-2, or maybe it's 1099-K1 from an employer. And they find out they can't do nothing about it. So now they're in real estate with additional cost. Equity's been deployed for what? Can't do anything about it. Because the way the government looks at your tax situation, if you will, okay, when they're filing your return, is they do separate passive income in comparison to active income. Okay? It's no different than what you and I do when it comes to investing in dividends or building out a dividend portfolio. There is income generated from passive efforts, and there is income generated from active efforts. Well, you go and clock in at your job, that's active employment. You go in and work for your own self and building your own company, that's active employment. It's not saying that your time and effort into formulating a real estate portfolio is any less,
right,
but the government views it differently.
Yeah, it's like a pension and Social Security, for instance, right? It's income, but the way the government looks at it is, well, pensions and Social Security is passive. And then, like you mentioned, your W-2 income is active. Is active, yeah.
Right. And so as a result, what the government doesn't allow is they don't allow for you to create passive losses, which is very easy to do in real estate.
Yeah.
Okay. Create passive losses that will offset on the other side your active income. Okay. Or tax liabilities as a result of your active income. Now, there are ways to get that to happen. Okay. And so one of the conversations we want to have is on the subject of depreciation and how to max depreciate. Okay. What we do and what we have recommended and have assisted clients, especially in that situation, they got a massive tax liability. They know that they need to solve or create a solution for it. We're going into real estate with the mindset of what type of real estate do our clients need to purchase, literally, what type, that's going to give them the best benefit to offset their federal tax liability on the other side of their plan. And so the reason it's important to know ahead of time is because, Mo, think about it this way. Should I go buy a short-term rental or should I buy a long-term rental? Well, it matters. Should I buy a property that is fully, turnkey, move-in ready? Or should I buy a property that's, 30-40% of equity away from being rented, right? Meaning I gotta go dump $100,000 on a $200,000 property just to get it up to speed. So all of that matters when you're trying to recognize how much you need to reduce against your federal liability.
Well, if you take those two that you mentioned, so because you've done, let me think about this. I think you're in all four of those scenarios. Oh, you've been in all four of those scenarios.
Yeah, personally.
Yeah, personally.
I think I am.
I think you have. Okay.
Yeah.
So let's talk about it. So
speaking from some situations where I've done right and wrong.
Well, I didn't. I wasn't going that way.
Thanks,
but
Mo.
No, I meant like those four different scenarios as far as long term, short term,
Commercial,
residential, and even like turnkey, quote unquote turnkey, and having to put some sweat equity in it to build. Okay, so let's take the first two where you mentioned long term, short term. Mm-hmm. Okay, so I know where you're going with. You're going with cost segregation. I'm assuming that's where you're going with this. So why would it matter long term versus short term if I'm going into buying a property for tax purposes? Okay,
so
long term, short term. Where do I go, or what's the pros and cons going long term or short term?
So simple enough, right? When it comes to our conversation of how the IRS views passive, non-passive income, okay, or passive and active, they view long term and short term the same, like separation, right? So the STR loophole, if you will, is short term rentals are properties or AKA businesses that essentially fall on the active side of your tax plan. Okay. So
that makes sense.
And it does, because, you know, to operate a short-term rent, the government basically says, look, it's like a hotel. Okay. Or they put it in the same category as a hotel or something like that. So the idea is it is active income because the tenants are there on average 7 days or less.
Yeah.
So you're constantly working on booking. You're constantly working on generating the income, handling the cleaning, handling the property, you know, and so with the massive turnover, the government kind of gives you that benefit of the doubt. Okay. Which is nice, which means with short-term rentals, it's easier, I'm going to say easier, to create losses that will offset your income from your other job, if you will, W-2, net 1099 K-1.
So is that all it takes? You just have to be a short-term renter? I mean, to have short-term rental and own it, and then by default, you're able to offset the now it's considered active income.
Yeah.
So now you're able to offset losses against your other W-2 income?
Well, you have a property that naturally will offset.
Right.
Okay, so that's good. Now it's a matter of how you create the loss.
Oh my gosh.
Yeah.
Okay.
So then it's like phase two. So
Okay.
phase two is what type of property do I need to buy? And then from there, how well does this property need to be put together before I buy it?
Okay.
Is a good question to ask. So as an example,
Regardless if it's long-term or short-term?
regardless.
Okay.
Okay. But in this situation, on the short-term rental side, and I guess it applies to both equally. Okay. But cost segregation. Okay. Real quick definition here. Cost segregation is the ability to identify separately all the different components that make up the value of your property. So what's the first thing you do when you're looking at a property? You're trying to analyze the actual value, current value, present value of the property. So when you do that, you know, you typically get an appraisal.
Yeah.
Okay. So you get the house appraised. The appraiser comes back and says, hey, the property's worth $500,000. Well, $500,000 isn't just nothing. Like it's made up of a lot of components, you know?
Yeah, I mean the appliances, the floors, the walls, the shiplap, basically everything, right? Everything that's part of the house itself, the foundation, everything that's involved in building this house is worth in this scenario $500,000.
That's exactly right. So all of these different elements and items make up the appraised value of the property. Okay. Now, with that said, the government doesn't know initially what all those elements are broken out. So what do? They give you a standard depreciation measure.
Which is what we were talking about earlier, which what most people will take.
That's exactly right.
From the front end, right? Just depreciating it over time.
Yeah, so you're talking, and to be specific, that's for residential 27 and a half years.
Yes, 27 and a half,
right?
yeah. And 39 for commercial,
39
yeah.
for commercial, right. So the government says, look, I mean, this is no secret strategy. We just don't know. And so because we don't know all the separate components that make up your house, the fridge, the HVAC, the plumbing, the subfloor, the walls, et cetera, we're just going to say, look, the whole value can be depreciated over 27 and a half years, okay, or 39 commercial. So cost segregation is the idea of hiring a company to come through and simply separate all of those line items for you and for the government. Why? I say it's for you because then you can take that and your accountant and go to the government and say, hey, look, some of these items here, they're not lasting 27 and a half years.
Yeah.
Okay? There's just not.
That makes sense.
Which the government knows that, right? They know that. So they're allowing you to take those items if you want to and max depreciate on the front end. Okay? It's depreciation you would have otherwise over 27 and a half years. You're just getting the ability
to front load it.
Front load it early in your plan. Okay? Now, that doesn't mean it's the right thing to do. It's just an option. Okay? You could definitely max depreciate. So
that makes sense because you probably can't, because if you're max depreciating it in 24, then 25 you can't for those same items.
Right. Yeah. So, I mean, if you took your, $2,500 fridge and depreciated 100% of the value year one, well, there's nothing left to depreciate year two.
Right.
So, and if you have to go buy a new one year three, it becomes a different situation, a little bit more complex. But so back to your original question. Does it matter if you're buying a house fully completed or fully not? Well, and this is just, I think, full disclosure. It's not you and myself. We don't claim to be the end all be all when it comes to real estate. But one area that I think is of interest that you could ask yourself is, depending on the price of the house. So if I'm buying a less expensive property value, I'm just throwing a number out there off the hip. $250,000 or less, okay? $300,000 or less.
Okay.
If I'm buying within that range, could it be possible that, buying a house that is unfinished or that will require a reasonable amount of overhaul, okay, be better for me than buying it fully complete? And I'm going to say, it might be better to experience, if you have the capital, the remodel process. Now, you got to have the capital to do that, right? Because otherwise you put 20% down, not a big deal. In this case, you got to put 20% down and cover the overhead. Right. Yeah. But the benefit of covering the overhead is that it takes away the natural cost of having to create a cost segregation, having to hire a firm to do that. Why? Because, you just spent $85,000, $100,000 in the remodel. So you you got the line items, right? You purchased the fridge, so it's an asset. You know how much it cost, and you can depreciate. You paid for the plumbing, right? So you know how much it costs, you can depreciate. So in that situation, I think you do need to be mindful, of what type of property, long-term or short, and, what condition of the property you're trying to get in to support your tax plan.
That makes sense. That makes total sense.
It's just like anything else. You just need to kind of think ahead, a little bit on what your end goal is and what your why is, and then come back and make sure.
Yeah, I mean, one of the first episodes, if not the first episode we talked about, was why are you getting into real estate? We'll just take the understanding that everyone wants to get into real estate because of the financial benefits it can have, with it generating cash flow in some aspects or it appreciating over time. In addition to that, are you looking for it for supplemental cash flow, or are you looking for real estate to be tax advantage for you? Mm-hmm. And then once you understand that, then it comes a little deeper into long-term, short-term. Like you mentioned, should I fix one up, or should I just go ahead and just buy one that's ready to go? Right. And then once you understand that, then we have enough information to help you and guide you into saying, okay, well, if this is what you want to do for tax purposes, these are the types of property, these are the types of deals you want to get into.
Yeah, and then it's just a matter of finding the deal and getting in the right place. I mean, and it goes so much deeper
Yeah.
than what we can cover, in a 40-minute, whatever show. But the reality is real estate at the end of the day is a great investment. And it's a great investment to support some advanced tax strategies if it's warranted. Okay,
That's the key. That's a key word.
Yeah,
warranted.
yeah. Don't do it if you don't have a major tax bill. So if you and you would know.
Yeah, yeah. Everyone thinks they have a tax problem,
and it's all relative.
It's all relative,
right?
but really, going into this, you're talking about the capital that needs to be deployed, and everything you mentioned before, everything that you mentioned now. I mean, we're looking to really offset some taxes, right? So I would say if you're in 24% tax bracket and up, like this is the area we're talking about.
Yeah. Yeah, I would say for sure. You're 24%, 32, 34,
24 north,
40 aggregate. You're paying some heavy tax bills. And the truth is at that point you definitely need to consider some solutions. Now, real estate is an option, and we're not talking about, we haven't covered opportunity zones, 10-year limitations on deductibility or depreciation. We didn't talk about the downside about it, which is potentially recapture, depreciation recapture, which could be a challenge, if you do it wrong. But the reality is if you do it correctly, it's warranted because you have a big tax payment and you're trying to figure out a solution. You buy the right property, you do depreciate. Well, what you're going to find out is instead of giving the money to Uncle Sam, you're going to keep it in your pocket, okay? And when you keep it in your pocket, what you're going to do is do what you needed to do, or what you already did year one, is you're going to do it again.
Right.
Right?
That's the key.
Yeah.
That's the true benefit right there, is that instead of paying Uncle Sam, you get to keep it and then do it again and repeat it.
Yeah. And I would end with this. Season of life matters too. Oftentimes these types of benefits are warranted for the individual who not just has a big tax payment, but also has a reasonable tenure in which they look to participate in the real estate world. Okay. So as an example, if you're an individual who is selling a business, okay, and you have a massive one-off tax liability, okay, now there's some solutions out there, but cost seg and stuff like that. Buying real estate is more of a, it's more of a long-term strategy to reduce a long-term tax liability. Okay. So I think that matters.
It does.
If you're 65 years old, you're 2 years away from retirement, sometimes it's better just to pay the dang tax and be done with it. Just, hey, shake the government's hand, be done.
Yeah.
Get your money net and then work with it from there. Focus on quality tax efficient strategies, aka AMG Tax Sense models.
Oh, I like that.
Yeah.
Nice plug.
That's because we do it well.
We do it well.
That was arrogant. No, but we do. We should be confident. All right. You got anything else?
No. That's good. I think that's a good way to somewhat put a bow on real estate right now. Again, like we have a conversation with the Morelands about flipping. But again, I think if you go back, listen to the series, you'll realize that investing in real estate is so profitable. It's so beneficial. It's such a great place to add value to your overall portfolio, but you got to do it smartly. You got to take time. You got to be diligent, and at the end of the day, have a good team behind you to guide you through the process.
Yeah, I think that's well said. And then also just one more reminder: the book that we're going to get into in this summer. Man, I think it's going to be fantastic. I think the content's going to be incredible. And I think at the end of the day, you and I both have and are raising children.
You know what?
What?
We should probably have one of our kids on the shows.
Well,
depending on
as
how
we
the
read
book
the
goes.
book and figure out how much we've messed up, we should gauge it. No, the reality is it is going to be a great show, no doubt. And I'm looking to learn. I think part of your mission and mine with Beyond Tomorrow is just, hey, we're living examples. So just kind of living that out with the people that are also watching and listening to the show. It's just, learn as we go and try to get ahead of the game so that less mistakes happen.
That's right.
Because we're being mindful about where we want to be tomorrow. So with that said, that's it, Mo.
That's it, man.
That's a wrap.
See you next
All
week.
right, that's it. We'll see you next week.